So stocks are selling off. We have you covered. Keep it.
Join me, Oliver Rennick, alongside Schwab Network's options experts as we explore the second derivative. Gamma On is a brand new limited series to take your trading skills to the next level. Subscribe to Schwab Network's YouTube channel now.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Binge watch the market with Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com on all your streaming devices. Schwab Network is available anytime, anywhere, on any device for free. No place better than the Schwab Network.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education crafted just for traders. Also, you can trade brilliantly.
Good afternoon and welcome to Market on Close. I'm Oliver Rennick. 1 hour left in the day. Stocks have erased early gains. Were unch for the S&P. NASDAQ basically the same, but the Russell is down now after a pretty strong early start. Got a nasty fade in the Russell, up 1% after inflation this morning, but coming right back down. So small caps fading, and the bond move also fading. So if you have been with us since the print came out or were tuned in to MTL, this may not be a surprise. As Kev put it this morning, a lot of positive numbers still on inflation. It was kind of odd why the bond market seemed to be celebrating it. Kind of odd that the short-term rates jumped to 80% plus for a December cut. And particularly the early sign that that was going to reverse was in the dollar. So it was fine to kind of debate the inflation point. And when the bond market was rallying, the dollar was down. But as soon as that dollar started firming up, as I pointed out this morning, that's usually the tell that yields are going to go higher too. Now, I could also sympathize that perhaps there's a bit more of a Trump trade in the dollar than bonds. I wrote about that in this morning's newsletter. Go check it out on schwabnetwork.com and sign up if you don't already for the Market Minute. Point is that, yes, we're going to put tariffs on. Perhaps that does kind of skew dollar strength a little extra, but we don't really need a lot of policy to explain generally better than expected economic data. In fact, the Fed probably threw a little juice into the economy by swinging that hard with 50 basis points in September, put the low in for yields, got the dollar moving too, and now the greenback really ripping today was the tell that bonds were going to fade. So here we are with the 10-year futures unch after being up more than 40 basis points. And generally, the dollar too is still very strong today. Going kind of in the order, though, of trend versus out of trend. Bitcoin just faded pretty hard there, but you know, all things considered, what are we talking about here? We've got 90,000 for Bitcoin. In trend is Bitcoin strength. So unless something really shifts around here, if you see a big red candle, if Bitcoin goes back below overbought, then maybe we have a separate conversation. But right now it's pretty clear that crypto is in trend to the upside. We do see the overbought. That's a good thing for Bitcoin, in my opinion, because that's when you get the really frothy, juicy moves. So that's still riding momentum pretty convincingly. Now, the rest of the market does start to look more nuanced. I would say generally, though, you could still characterize all this move as in trend. VIX is still down. That's probably the most important near-term trend. I mean, really crucially, just volatility continuing to come out of the market, especially for options traders. Probably the most important thing happening. Again, something we talked about going into the election, that unless it were going to be a big disaster, vol would come out of the market. And so we continue to see that happen. Volatility dissipate. VIX down pretty low now, below average to 14. Again, perhaps something we revisit if bonds keep stealing the show, but for now, Bitcoin up, VIX down, tells you it's a lot, generally more of the same. And here's the thing, too, is that the dollar up and yields up is part of this trend, too. So everything here generally still mostly in trend. And if you zoom out over the last couple months, even the last couple weeks, so there's no reason to really get too worried. But we would want to see how some of these relationships develop in the coming days and weeks. Given the move for yields in the dollar with a lot of conviction higher, stocks have been able to take that in stride so far, but it stands to reason at a certain point they may not. So that's something to come back to. Also, gold, kind of a little out of trend, and maybe a new one developing as the strength in the dollar really adds on. It makes the case a little bit more tricky for the gold bugs. I would also kind of take that back to the Fed conversation and say perhaps the Goldilocks environment might be a little bit weaker here if the Fed's going to have to stop cutting. Gold likes inflation, and gold likes a lot of things, but generally what it doesn't like is if you're going to see one of two things, a reversal by the Fed to something more hawkish, or if you're going to get just good times and euphoric type of activity. I mean, you got Bitcoin ramping up, you got stocks ramping up, and now you might be getting a decent case to actually own income and bonds again with yields going higher. So you kind of put all those things together, it just takes a little bit of life out of gold, which is sort of a catch-all trade when you're not really certain about what else to do. But if you're certain you want to take risk, then you go with Bitcoin over gold, and you could go with stocks over gold. And then if you're looking for just kind of a steady grind, well, maybe you can replace gold with income and bonds if yields keep going up, or if maybe the Fed has to stop cutting. So for the coiners, general trend solid. For the gold bugs, a little bit trickier here. The other thing, too, is just the tech story is getting kind of choppy. Semi's down 1.5%. They've really gone nowhere now for a couple months. And NVIDIA looks like it might be creating a little bit of resistance up at 150, the top right side of the chart there. So it's a little mixed up. Some stuff kind of competing with itself a little bit here in terms of short versus long and intermediate term trends. But that's your session. It's mostly about the fade from this morning in bonds, the big rise in the dollar, and now some of the give back and risk assets from Bitcoin to stocks. I got Kevin Hanks, Jenny Horn, back with me here this afternoon. So when we talked about inflation, Kev, I think we, in retrospect, had a good discussion this morning because the dollar was the first to take off, bonds faded, yields turned around, and now maybe we look at that number with a little bit of a different perspective than not the one we looked at, but the way the market was looking at it this morning.
Well, the market certainly, I mean, all you have to do is look at those 1-minute candles when the number came out, and bonds rallied hard off that number, and so did futures, frankly. And I'm not sure if it took a while to digest, or they looked at the numbers or what happened, but you know, it sold back off, but then it made a late morning rally too that was fairly strong. And what does that mean? Well, maybe it's getting a little whippy up here, up at these levels. The air is getting a little thin, and it's hard to look at a dollar higher and now yields that were lower and now slightly higher and make a good case for why rallies shouldn't fail or aren't failing. And sure enough, they are. As we speak, it's failing. So this is not a real shocker. But if there was a surprising point of today, it was the initial reaction. Like, what did the market see that it liked other than, I guess, in line with consensus, maybe, is what it liked.
Yeah, I agree with you there. As we talked about this morning, it seemed like it still leaves some optionality on the table. I was kind of surprised to see the way Fed funds futures jumped to 85% pricing for the D's cut. It's just, I'm not really sure. You know, that was a coin flip like yesterday, and it seems like it should be closer to a coin flip for me.
Apparently, the machines that may be driving some of the trade based on momentum should check their macroeconomic textbooks because they weren't getting it right, and maybe they don't care. They trade on momentum, which, let's face it, Oliver, these days, there's a lot of momentum driving a lot of these assets.
I don't know about that, though, because bond momentum has been for lower in price. I mean, the trend has been higher in yield. So if you're following momentum, then momentum was to fade the bond move.
Yeah, but in a short term, the momentum was they bought bonds on the rally, and then it just fed on itself for a while, and then eventually it ran out of gas. Yeah. But there's been a big change in how this market, and this is not days or months, it's years, how it reacts to data. And it reacts violently to some of the data and quickly, like seconds.
Well, to your point, I think it's more that you kind of got that number that wasn't hot, and then the kind of, machines clicked to bonds rally on that, but it got more nuanced throughout the day. I mean, hey, even Bitcoin's only now up 1%, so we've kind of lost some of our appetite a little bit from this morning, Jenny.
I know, I've been trying to find, I will say, there's still like these outsized winners on the session, like Rocket Labs for some reason caught my attention. I mean, like hugely up, giving back some of that strength though, and then you have, names like Rivian also, which was up over 18%, giving up that strength. I think that the Bitcoin narrative and momentum has to take some pause. I mean, I am a skeptic of like these rallies that we see that last for like 10 straight days. I think that the reset is necessary, but maybe that's just my skepticism speaking. But with Bitcoin pulling back, I mean, I think that's good, right? It's listening to the overall market. I think that you can't have basically an asset that's trying to trade on its own, maybe like election hype. I think that we already know at this point that the election and the Trump administration is going to be a friend to crypto. I don't know why we continue to just rip.
That's a very fair point. Like, you got to have some justification for some of this at some point. That's where it seems like, you know, the bonds and the dollar story maybe doesn't need so much new justification. It was already in trend, but, you know, some of these stocks, some of the crypto stuff too, it's like, all right, you can speculate, but who knows what's actually going to happen. Tesla today slipped a little bit after yesterday's big decline. So the kind of overcooked notion of a few of these Trump-specific trades maybe are starting to play out here, Kev.
Part of the discussion we had today on Fast Market was about is the story about Bitcoin more of a just acceptance leading to momentum, right? It's like Trump equates to more acceptance of Bitcoin, and therefore it's really that's the fundamental great.
No, literally, we had the guy from CoinDesk on the other day, and like his same argument that I had, which was this is the asset that moves the most when people talk about it, and people are talking about it. So like beyond that,
to more acceptance, not less.
Yeah.
It is amazingly, like somehow for like a coverage standpoint, it always seems to come in and we are like news-led. It happened with the election, but I really feel like over the last several weeks, even it's like center stage because of the election, but it's like there really isn't a whole lot else other than like CPI going on, and somehow it's like once we lose that and focus on an Nvidia, we just recapture it in like a Bitcoin.
steals the airwaves. VIX down basically is kind of one of the biggest takeaways, I think. So what do you make of that, Kev, with stocks mixed?
I think they're taking a lot of volatility and uncertainty out of options. Is it all warranted? Hard to say.
Yeah.
Hard to say. It's based on going into the end of the year and a proposed mild or moderate or not choppy markets. But wow, to see the VIX below 14 when it was just it felt like yesterday it was 22.
Right. I think that's kind
a
of
violent move.
Yeah,
Another violent move.
Fits with kind of the notion of maybe a little bit of euphoria kind of creeping in that we might have to revisit. Hey, real quick, Jenny, semiconductors a week again day. Part of it's coming from Skyworks. Give me like a real fast rundown on that. What happened there?
Okay, so following a disappointing guidance, I think that what makes the story so interesting though is that Apple made up 69% of its revenue, and that was up 21% from last quarter. So you could say the Apple bump should have been beneficial to this company, but no, they're expecting a lot of the same going forward. I mean, this is a pretty good read on Apple, at least as far as one semiconductor is concerned. Not really good to read on Android. They have a relatively small exposure, $100 million in revenue, but I just didn't realize not only is that 69% of their revenue growing, it's growing substantially, up 21% for the quarter. Do you want that much Apple exposure? I think is the question now, because if you believe in Apple, you love this name. If you're a skeptic about the growth and the AI and all things Apple Intelligence, you'd have some skepticism right now.
Yeah, majority of the revenue comes from Apple, so kind of a curious one that Apple's a little changed on it. Maybe Skyworks is moving lower down the totem pole of input into Apple, but still, I mean, for them, there's a lot of stuff down 49%. Chips have been kind of ugly, kind of dicey lately. Thanks, Jenny. Thanks, Kevin. Appreciate that. Let's talk some more of the big picture inflation potential with Colin Roche joining us, CIO at Discipline Funds. Colin, great to see you again. Congrats for making it through the election.
Hey, Oliver. Thanks for having me.
Okay.
Yeah, I've got a spicy take for you today.
Yeah, I know you do. I'm excited because right now we've got bonds selling off. Again today, faded on inflation. Some have been arguing that the move in treasuries is Trump-related. I've kind of argued, I've pinpointed to like 85% economy and Fed, maybe like 15% Trump, but sounds like you think maybe it should be the opposite.
Yeah.
Like zero Trump, like maybe negative force.
It's impossible to know what Trump is actually going to do. But I think right now the baseline estimate is that you're going to get big tariffs, you're going to get big deficits, and that means potential for big inflation. I find all this really interesting, especially look back at the first 3 years of Trump's first term. So right before COVID hit, when we started to get the kind of the deflationary hit, you had 1.7% headline PCE over that period. So inflation was very, very muted during Trump's first term before COVID. So I think that going forward, this has to kind of be your baseline assumption, because a lot of the same policies that people are worried about now that are supposedly going to be inflationary were the same sorts of things that Trump was doing the first time around. The big tax cuts, big deficits, the tariffs were always a worry. And I find the tariffs interesting because I think that Trump is really using this more as a negotiating tactic than anything else. I think he likes to be able to come in with a big hammer and bluster and sort of almost threaten people about.
Though going back, though, I mean, obviously the starting point is very different here for inflation than it was back then. How does that potentially kind of change the possible outcomes when you've already got nominal prices elevated?
Yeah, that's an interesting one. So, you know, if me personally, if I would never be elected president because I would never want or be elected by any sane person to do such a job. But if I were ever coming into office, I would never want to come into office at a time like this where things look relatively robust. I mean, you really want to come into office during a
right.
like the pre-COVID period or during COVID when everything's sort of getting killed, or the Obama era where you come in 2009 and like everything can kind of just only get better.
It's like now's the best time to become the new Boeing CEO.
Yeah, versus now, everything looks sort of hunky-dory, rosy. The stock market's hitting a new high every day. How much better can things get? But more importantly, when you start to look under the surface, especially at the labor market, things have been softening. And so even though everyone feels relatively euphoric, the labor market has been softening especially over the last 6 months. And this is especially interesting in the context of Trump because Trump is potentially going to nuke a lot of government jobs. And when you back out government employment from the headline figure on payrolls, the last 6 months only average 100,000 jobs. Last month's payroll report would have been negative minus the government jobs. So a big, I think, question mark in all of this is how much is government going to get cut in the next 6 to 12 to 24 months? And how is that going to impact a lot of these labor reports? Because ultimately, the labor reports are the things that really now are driving Fed policy. I think the Fed's relatively comfortable with inflation. They want to see where employment is going now. So if you get a bunch of soft employment reports and they're exacerbated by government job cuts to the downside, we're certainly not going to get a lot of government job additions going forward. So a lot of this is going to depend on, how serious is the DOGE department, the Department of Government Efficiency that was just apparently created yesterday, and how seriously is Elon Musk and Trump going to take a hatchet to the government and the number of employment jobs that we're going to have going forward there.
Let's run with that, Colin. I think it's a really great point because when we talked with Vivek Ramaswamy here on the network, he was giddily throwing out numbers of 1 to 2 million jobs he thinks are basically disposable. And then when I asked him, okay, well, how does the private market absorb that? Was some paper pusher at the Department of Energy going to work for NVIDIA? He basically said it's not really their job to figure that out, that they should have been jobs that were created to begin with. So, I mean, that does kind of sound deflationary. I feel like that's probably the strongest part of your argument. If you're laying off a bunch of people who flip the employment chart negative.
Those are huge numbers. I mean, there's 23 million federal government employees right now. I mean, if you cut a million, what is that? That's like 80,000 jobs per month over the course of the next year if we actually eliminated a million in the next year. So you're talking about, I mean, boy, can the private sector absorb all of that? I mean, God, you've got the U1 rate, so the long-term unemployment, people unemployed more than 15 weeks. I mean, that's been ticking up for 6 months here. That's like kind of one of the big red flags in the labor market already. So, I mean, I don't think these jobs are going to get soaked up by the private sector anytime soon, certainly not immediately. So are they really going to cut a million? I find that hard to believe. But even if they're cutting, say, gosh, I mean, 100,000 or 500,000, that's going to have a big, big impact.
Totally. All right, totally with you there. However, the counterpoint, I guess, would be the way they talk about the Fed really gets you into this pretzel of logic that I don't even really want to try and figure out. But here's one thing I would offer. Vivek also told us that he viewed the Fed as abetting inflation. So if that's their mindset. Now, reports are saying they're not going to mess with Powell or anything, but we also know that they're totally comfortable in the public speaking against the Fed. So if they think the Fed's abetting inflation and the Fed's been now cutting rates, does that mean they're going to have them start hiking rates? How do you think about the monetary side? Because then on the other hand, Trump says he loves low rates. So I have no idea how any of their logic fits together right now, which seems like, how do we even predict anything then if you think monetary policy has got a big role in inflation? I guess you could argue maybe it doesn't.
Right.
Go ahead.
Boy,
It's a mess.
If you held a gun to my head, I would say Powell has about 14 months left on the job.
Right, which certainly does, yeah.
So I would be shocked if look, Trump made his whole business empire in an era of accommodative interest rates. We know during his first term, he berated the heck out of Powell for raising rates back then. He only knows and loves low interest rates. So he's going to push for low interest rates no matter what. I think even if inflation were to tick higher, and let's say Powell just holds the Fed funds rate where it is, Trump is going to kick and scream at him the whole time. Powell sounds like he's going to hold to his guns here and probably, try to stay as independent as possible. But I think 2026 rolls around, and if Powell isn't, taking marching orders from Trump, he's gone. Trump will put in a yes man or someone that's much more accommodative to whatever Trump likes, or someone that's a lot more dovish. And I'd be shocked if you don't eventually get much lower interest rates at some point during the Trump term, especially if a lot of these sort of inflation scares don't come to materialize. So I would assume that at some point during the Trump term, you get much lower interest rates just by virtue of Trump, blustering it into existence.
Boy, that's where it's like, maybe you don't think it's inflationary, but do you go and short bonds on this? Do you go and buy bonds on that view? Because right now, every time the Fed cuts, yields are going up. So if you think if you think Trump's going to cut, then you short bonds.
Yeah, I mentioned this last time I was on, that there was this whipsaw effect that after they cut, the big cut, the market dropped to, the 10-year dropped to 3.6, and that created this sort of price compression where there wasn't really a lot of upside in bonds at that point because the long-term target for the Fed is only 3, so 3.6 on the 10-year, and it didn't look that great back then. Rates at 4.5, 4.5 here on them, not the best trade in the world, but if you've got a target of 3%, I think over the course of the next 2 years, locking in a 10-year T-bond at 4.5% isn't the worst trade in the world. It's probably not a huge amount of upside unless you really get a deflationary scare. But I'm not in the Druckenmiller, Paul Tudor Jones camp that says that interest rates are going to shoot higher. I still don't see, even with today's a little modestly worrisome CPI print, I still don't see a lot of upside in inflation at this point. The labor market's softening. My baseline is still that interest rates probably, we do get to that 3% target. It's just going to be a matter of how bumpy is the road getting there. And so far, over the last 2 years, we're going to get there. It's proved to be a really bumpy ride. So yeah, you got to fade these big moves to the downside when we get too deflationary, too worried about recession risk. And at the same time, when rates jump up higher to these interest rates that are getting close to 5-ish on some levels, that starts to look pretty good, especially on an inflation adjusted basis where you're still getting a real return of 2.5% in some cases.
Yeah, fair enough. Right. Colin, fun take. Glad to catch up. Thank you very much.
Thanks, Oliver. Have a good one.
You got it, Colin Roach, CIO of Discipline Funds. All right, good macro talk. Let's come back, get into the weeds, into the realm of earnings, tech, and software. Checking with the team at Pubmatic. We'll be right back.
Accelerate your market knowledge.
And shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hicks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to Market on Close. Let's get into the weeds on some earnings. Joining us, Rajiv Goel is the CEO at Pubmatic, PUBM, revenue and rather advertising software business. Rajiv, welcome back to the show. Absolutely. You're here last quarter. Your shares got hit on report. You told us about some of the kind of temporary kind of transition that the company was in looking forward. Stocks climbed back since then. You got a little bit of volatility around earnings. Tell us the latest here and what's changed over the last 3 months.
Yeah, absolutely. Good to be with you. So we delivered an outstanding quarter with revenue and profit exceeding expectations on both the top and bottom line. Q3 revenue was up 13% year over year to just under 72 million. And we saw a really strong outperformance driven by CTV and political ad spend. And then adjusted EBITDA, 26% margin, 18.5 million, very healthy cash flow as well. So we're really excited about the quarter and where we're headed going into 2025.
Okay. Talk about some of the advertising trends mentioned around the election. What lasts, what lingers, and how you kind of capture some of the maybe shorter term like moments of content demand versus kind of longer term. So I imagine everything got pumped up around the election.
Yeah, I mean, you're absolutely right. Obviously, record amounts of money were spent on the election in this past cycle. I think what was new is that from a digital advertising perspective, a lot of that went into the connected TV or streaming channel. If you think about where the advertising was being spent, there were 7 or 8 battleground states in the presidential side of things, and so there was really a lot of activity by the political campaigns and the super PACs to make sure they're getting their message in front of those battleground voters. Now we've organically grown our CTV business, so we're working now with 70% of the top 30 CTV publishers. So that's all new in the last couple of years, and that part of the business more than doubled in the quarter. And so we saw a significant chunk of the political spend coming in CTV. But we also had a number of other great growth drivers, online video, mobile app, all up 20 to 25% in the quarter. So as we look forward now we're getting into the holiday season. I think there was definitely some crowding out of holiday or gifts, shopping, that kind of advertising by the political environment that was going on. But we're starting to see that normalize. Okay.
The market had underestimated your guys' numbers here, as you mentioned. Beating estimates, your own outlook, a few million, 296 for the fiscal year, 1,292. Previously shifted your guidance range upwards.